Hello and welcome to the Thursday, January 23rd, 2020 edition of Tesla Daily, unofficial Tesla podcast. My name is Rob Maurer. Today we are talking about some comments that were frankly pretty appalling from BMW as well as other Tesla competitors. We do have some Tesla news, but I'm going to save that till the end. I don't want to bury the lead here. The other thing to say is this is going to be a little bit different of an episode. I'm not doing pretty much any editing. I don't have time, and I'm trying a new style here to make sure that I can get the video out as well. So bear with me. This is all kind of a learning curve as we've talked about. So first things first, let's check Tesla stock. Tesla stock on the day today was up 0.5% to $572.20, which compared to the NASDAQ up 0.2%. All right, so getting to the BMW comments, this is coming from the head of R&D, Klaus Froehlich, who was actually a CEO candidate a few months ago before they chose Oliver Zipse. And this is an interview with Automotive News Europe. And I'm going to read a series of questions here and responses from Froehlich, and you can kind of just run down the list. And pretty much everything here I would just disagree with point by point. So the first question that they asked him here was, quote, except for the full electric i3, BMW only uses flexible architectures that can accommodate internal combustion, plug-in hybrid, and battery electric powertrains. Was this the right call? And Froehlich responds by saying, quote, a flexible architecture is the best solution for the next 5 to 10 years, but clearly if the world turns fully electric, we will develop dedicated architectures. End quote. So, BMW intends on not building pure battery electric vehicles from the ground up, which is a strategy that has proven successful for Tesla, obviously, for the next 5 to 10 years, unless the market completely dictates that they must. The problem is, if the market is dictating that, it's probably too late. BMW is saying right there, they are not going to be in a leadership position. Obviously, that's not super surprising, but to come out and admit that is an interesting tactic. The next question that he has here is, quote, what is the biggest hurdle to the mass rollout of full electric vehicles? To which Froehlich responds, quote, BEV cost, more because of the raw materials to make the batteries. This won't change. Prices could eventually increase as demand for these raw materials rises. So again, instead of doing what they can to make progress on battery electric vehicle cost, they're simply waiting around and assuming that there's nothing that can be done to change that, despite what we have seen over the last couple of decades in terms of battery prices and what pretty much everybody else in the industry is forecasting. So again, strong disagreement on this point. They then go on to talk about charging amongst some other things, but the first question on charging here is, quote, why then is BMW one of the founding investors in Europeans' fast charging infrastructure builder, Ionity? Froehlich says, quote, we had to, sorry, terrible laugh, we had to because in 2017, no one was willing to invest in a charging infrastructure. Now the situation is completely changed. Energy providers and oil companies are investing. So the charging infrastructure is coming. That's good news because this is not our core competency. Okay, so again, Froehlich here is saying we had to. If we relate that back to the response to his first question, he says we will develop dedicated architectures for fully electric vehicles, essentially if we have to. Noticing a trend here with BMW. They're only going to do any of this stuff if they have to. And now they're saying somehow that the situation has changed. Energy providers and oil companies are investing. Froehlich is relying on oil companies to build the charging infrastructure that is going to put them out of business. That is a troublesome plan for any BMW stakeholders. The next series of questions here also on charging, quote, what has BMW learned from the customers who are already driving its electric models? Froehlich says, quote, what we have learned, which is significant because by the end of 2019, we will have 500,000 electrified models on the road, is that customers recharge either at home or the office. Charging elsewhere seldom happens. So Froehlich is completely missing the point here of charging infrastructure. You need to have it available because that increases the utility of a battery electric vehicle, regardless of how often you're actually utilizing that charging network. If you can't go from point A to point B, well, that's a problem, regardless of if you only need to go from point A to point B once or twice a year. So BMW just continues to stick their head in the sand on charging. In terms of outlook for the next decade, Froehlich expects 20 to 30% of global vehicle sales by 2030 to be electrified vehicles. That electrified term is one he used in that previous answer as well. That does not mean a fully electric vehicle. That means anything from a fully battery electric vehicle to plug-in hybrid, really anything with some sort of electrification. Even with that lower bar, still only 20 to 30% globally by 2030. The interviewer then presses on that, saying, quote, and for Europe, end quote, in terms of that electrification. And Froehlich says, quote, "In Europe, there is reluctance to jump directly into BEVs, so plug-in hybrids are the right solution. They will be used as BEVs during the week and run on gasoline on weekends or long trips. We expect plug-in hybrids to account for up to 25% of European sales. Gasoline and diesel will have more than 50%, and the rest will be BEVs." End quote. So we talk about plug-in hybrids all the time. It's an inefficient half measure. You have to have two powertrains. That's much more costly than simply just converting the entire powertrain as battery costs continue to fall and as powertrain developments improve. Tesla is on this path and going to prove BMW that plug-in hybrids are not the right solution even for customers in Europe. The interviewer then asks, quote, "How about the US?" To which Froehlich responds, quote, "Most of the US does not need BEVs. We could offer high-performance plug-in hybrids in the M space, providing a lot of fun to the driver, as well as environmental credits for us. We see BEVs mainly in the West Coast and parts of the East Coast, while the rest of the US will continue with conventional gasoline engines." End quote. Let's remember, he's talking about 2030, 10 years from now, conventional gasoline engines. Again, point by point by point here, everything is just completely wrong. It's shocking. This is their head of research and development. Research and development where all of these things should be progressing. And he's saying conventional gasoline engines in 2030 are going to be the majority of sales throughout the middle of the United States. It's just insane. The next question on this list is about fuel cells, and this is the last question that I'll go through on this, but he says, quote, "Is the cost still prohibitive?" End quote, about fuel cells. And Froehlich says, quote, "Right now, a fuel cell powertrain costs about 10 times more than a BEV system. We plan to have those costs equalized by 2025 with the third generation of our scalable fuel cell system, which could result in volumes in the hundreds of thousands." End quote. 10 times more costly for a fuel cell powertrain than a BEV powertrain. Froehlich expects no improvement in BEVs, and he expects a 10x improvement in fuel cells over 5 years. It just does not add up, and this is why the thumbnail for today's episode on YouTube, if you are watching on YouTube, is the way that it is. I don't have high hopes for BMW. They may be one of the first to go. Again, this is their head of R&D, should be progressing these things, and is talking about conventional engines, plug-in hybrids, 20 to 30% electrified by 2030. It's just nuts. BMW is not the only other automaker that we have news from. We also have news from Daimler. They have given another profit warning, which is when you pre-announce that profits are going to be worse than expected. This is their fourth profit warning since May of 2019, when their most recent CEO took over. That's very frequent. They are anticipating for 2019 earnings to be 5.6 billion euros, which is 50% below 2018. They're also in the news with a report from Manager Magazine around their electric vehicle efforts, and they're reporting that Daimler wanted to sell around 25,000 of the EQC this year, but only managed to build around 7,000 of those electric vehicles. Furthermore, on the EV topic, Reuters is reporting, quote, "Daimler's Works Council Chief, Michael Brecht, told Manager Magazine that one of the reasons the company is struggling to meet battery demand is because Tesla bought Grohmann Engineering." End quote. That is quite the excuse, considering the fact that Tesla bought Grohmann Engineering in November of 2016. At least that's when the deal was agreed upon, finalized in January of 2017. So 3 years ago, and Daimler's Works Council Chief is now putting partial blame on that for Mercedes-Benz struggles to meet battery production goals. I mean, I know lead times are long on these things, but to use something that happened, something that a competitor did 3 years ago, as an excuse for why battery electric vehicle production today is low is pretty weak, especially considering the fact that in the last year, Tesla just built an entire gigafactory in Shanghai. Yeah, battery production isn't happening there yet, but I think the point still stands. The other part of this report on the EQC from Manager Magazine was that Mercedes was dropping their production goals for 2020 from 60,000 EQCs down to 30,000 EQCs, but Mercedes has actually since come out and denied that. Spokesman Jörg Hau saying, quote, "Daimler plans to produce around 50,000 Mercedes-Benz EQC models in 2020, end quote. I think the right approach here is to remain skeptical on both sides. I think we need to be skeptical of Daimler's targets to produce 50,000 EQCs if they did only produce about 7,000 this year. And then I think we have to be a little bit skeptical of Manager Magazine's reporting on this issue if Daimler does still indeed plan to produce those 50,000. I'm guessing it's probably somewhere in the middle. But the quote about Roman engineering apparently did come directly from Daimler's Works Council chief. So I think regardless, that was something that was actually said directly to Manager Magazine from Daimler. And again, is also pretty shocking. Next up in the line of other automakers to make pretty ridiculous statements, Subaru. So Subaru's CEO, Tomomi Nakamura, said over the weekend in a press briefing, and this is from the Wall Street Journal, apparently Nakamura, quote, said he didn't see much evidence Americans want electric vehicles or plug-in hybrids, and expressed frustration at navigating between environmental regulations and consumer demand, end quote. Adding, quote, the only EVs that are selling well are from Tesla, end quote, which is pretty much true, but it seems like no one ever looks beneath the surface to figure out, maybe why that might be. Perhaps even more interesting than that, Nakamura apparently, quote, said the company, which is 20% owned by Toyota Motor Corp, would work with Toyota on new hybrid technology and introduce a vehicle with the technology this decade. They are going to work with Toyota on a hybrid technology to be introduced this decade. Oh, man. This is quite a day for news out of other automakers. Not wanting to feel left out, in addition to Subaru's CEO, their CTO got in on the action, saying, quote, to be honest, we don't expect the market is going to turn into all electric vehicles in 2030. They're going to be quite expensive, end quote. All right, so we'll move on from Subaru. The next is Nissan on our list. And this is a quick one, but the ousted CEO, Carlos Ghosn, who is now, he's got some legal stuff going on, but he apparently said to his lawyers last year that he expects that Nissan will be bankrupt in 2 to 3 years. So good outlook there for Nissan as well. In addition, the ID.3 from Volkswagen may be delayed to 2021. These are sort of unconfirmed rumors at this point. I have been seeing some things that maybe VW sent some communication on this to reservation holders, but I haven't been able to confirm this myself. That email was a little bit confusing in its wording, so it could be interpreted incorrectly by some people that are reporting on it. So just something to keep an eye on, but that may end up being delayed as well. So I think that is finally it for news from competitors today. And I know the thumbnail is about BMW, but I think we can apply that to probably all these guys here. Next up, in terms of Tesla-specific news, we don't have a ton here, but we do have some analyst price target changes. So the first one here is from UBS, which apparently has a new analyst appointed to their coverage of Tesla. If you remember a couple months ago, it seems like they dropped coverage. There was some reporting on that, as there was some SEC investigating that seemed like it may be connected, maybe not. We never got any clarity on that. But apparently they are still covering Tesla stock. They do have a new analyst, as I said. It is now Patrick Hummer instead of Colin Langan. So they have increased their price target on Tesla from $160 per share to $410 per share. And apparently this is based on 1.1 million cars sold in 2025 at an 11% operating margin with a $10 billion autonomous vehicle opportunity included. So I would say that 1.1 million cars sold in 2025, as we've talked about with the Adam Jonas note recently, is definitely really low. But that $10 billion autonomous vehicle opportunity, I think, is anybody's best guess of how that comes to fruition over the next 5 years or so. Obviously, if you're super bullish on full self-driving, that would be low. If not, maybe a bit high. So tough to say how that translates back to 410. But he said based on the current stock price, you would need to do about 1.6 million cars in 2025 at an 11% operating margin, which again, that even is low. Hummer, though, did say, quote, this is a stretch because it requires perfect execution, strong EV demand growth, and at the same time, failure of the incumbent OEMs to launch competitive EVs, which, as we just talked about today, seems likely. The other analyst update was from Exane BNP Paribas. They have downgraded from a buy rating to a neutral rating with a $555 price target. Not sure exactly what their price target was before. Haven't been able to find any quotes or anything on this one, but they did downgrade their rating. The last thing today is on Tesla's Q4 earnings call that happens on Wednesday, January 29th. And Say Technologies, which is the company that aggregates the retail investor questions for those calls, today opened up the submission process for the Q4 call. So I have submitted my question, and I would encourage you, if you think it is a good question, to follow the link in the show notes below to upvote this question, because the top 5 upvoted questions generally are the ones that are asked. And right now it's not in the top 5 because I didn't get there fast enough to enter it in to get the traction. But hopefully we can make up for that. So my question is, quote, Tesla's vehicle delivery compound annual growth rate has increased each of the last 5 years, and sits at 88% over the last 2 years. How should we think about that rate going forward? Will Tesla achieve that by expanding Gigafactories 1 through 4, accelerating the pace of new Gigafactories, or both? End quote. So the reason that I asked the question and kind of phrase it this way, I always try to think about how Elon is going to respond to these sort of things. But in this case, I want to get him thinking about longer term. And I think one of the biggest questions out there is, once Tesla scales up Gigafactory 3 and 4, does Tesla's growth rate from that point on slow to something more reasonable in terms of other large companies, something around, 10 to 20, 25% maybe? Or can we actually stay above this 50% annual growth rate in vehicles? And actually, since Tesla has been accelerating that, could we even see continued acceleration of that growth rate in the future? So the compound annual growth rate, if you're unfamiliar with that, that would just be the growth rate that would have to be maintained year over year to achieve the total growth over a given period of time. So just as a quick example, let's use a 2-year time period with a base of 100, and let's say you grow 50% both years. In the first year, you go from 100 to 150, 50% growth, pretty simple. In the second year, if you grow at 50% again, instead of going from 150 to 200, you're going from 150 to 225. Because of that compounding factor, your base is growing. So over time, Tesla has actually accelerated their compound annual growth rate. The 6-year compound annual growth rate currently sits at 59%, the 5-year at 63%, the 4-year at 64%, the 3-year at 69%, and the 2-year with Model 3's introduction at 89%. And I know in my question I said 88 instead of 89, so embarrassing, but it is 89% over the last 2 years, again with Model 3. So each of those years, we have consistently seen that growth rate accelerate. So back to the point of the question, I really want to get Elon thinking about that and how that can be maintained and giving us some insight into what that looks like. I'm guessing it's a combination of both, but they can't build 1 Gigafactory every single year and maintain growth as that base becomes more and more significant. If you're producing 2 million vehicles per year, to grow at a pace of 50% a year, you need to add 1 million vehicles to that production rate. You can't do that with the size of today's Gigafactories. So then you need to start building 2 concurrently, and it just increases from there as production grows. So my hope is that gets him thinking long term and allows him to sort of freeform his answer as he sees fit. That's usually what I try to elicit when I ask these sort of questions. So if you agree with that strategy, check that out and upvote that. If not, there are plenty of other great questions there too that are well deserving of upvotes. So check that out if you want to have any influence on what gets asked next week. And that is really it for today. So as always, thank you for listening. Thank you for bearing with me through this style. I hope it turns out okay. We will see. I'd also encourage you to follow me on Twitter at Tesla Podcast. And if you want to support the podcast, you can find those details at patreon.com/Tesla Daily Podcast. Don't forget to subscribe. That helps me out as well. Don't forget to share. And I will see you on tomorrow for the January 24th episode, Tesla Daily. Thank you.